How many of you were in my corporate finance class too? How many were in my corporate finance class as well? You can't hear me still? Let me turn up the mic. Can you hear me now? Better? Okay. That's how many of you are in my corporate finance class as well? I've spoken to you more than I've spoken to my wife in the last year and a half, right? 52 sessions. That's a lot of talking. Anyway, this is it. After today, no more lectures. Show you everything is relative. I had my corporate finance class this morning. There are 430 people in the class. After 430, 150 seems almost intimate. It's so much easier managing 150 people than 430. But it was a wild and crazy night getting all the summaries together from two different classes and matching them up. You guys did pretty good. I got 132 out of the 150 people in the class, roughly speaking. So there are 18 missing. If you haven't sent me your summaries, if you send them in, those of you who were in my corporate finance class know I take the entire list and I put it online so you can see. I don't put names, so don't worry. Your name is not attached to your valuation in case you're worried about it. But you will see the list of every company valued in this class, and the value came up with DCF value. What you basically send in the summary will be in a summary sheet. So if you haven't sent in your summaries and you want your name to be in there, your company's name to be in there, just send it to me and I'll see if I can add it in. Here's what my plan is for today. I'm going to basically talk a little bit about what you sent me, the DCF valuations, relative valuation. Use it as a vehicle to kind of explore, kind of do an overview of what we've done in the class. So there were three basic approaches we said you can use for valuation, right? Discounted cash flow valuation, relative valuation, and applying option pricing and valuation. Every valuation approach we said has to fall into one of these three buckets. In discounted cash flow valuation, we try to estimate the cash flows, we try to assess the risk, come up with a discount rate, take the present value, and we said that's the value of the asset. In relative valuation, we kind of give into the market. We let the market tell us what something is worth. It's less work because the market does the work for us, but in a sense it's dangerous because the market doesn't do its job well. We're going to feed that into our valuation. And in option pricing, if you think about it, basically we're just moving value around. We're asking who's gaining, who's losing. So if you think about equity as an option, we're essentially transferring value from the lenders to the equity investors. So with that in the background, let's think about the basic inputs that drive every valuation. Okay? So you can step back and think about this, whether you did relative valuation or discounted cash flow valuation. There are four basic questions we try to answer the value of a company. The first is, what are the cash flows generated from existing assets? We grind through 10Ks, annual reports, financial statements to come up with this. Those cash flows can either be before debt payments, in which case to the firm, or after debt payments, in which case they're to equity. And a very strict version of this model is a dividend discount model, which is an equity valuation model where the cash flows paid out to equity investors are viewed as their cash flows. The second input is the discount rate matched up to the cash flows. If your cash flows are firm cash flows, pre-debt cash flows, the discount rate has to be a cost of capital. If your cash flows are equity cash flows, the discount rate has to be a cost of equity. Third basic input, and this is where we all run into issues because you have to make, when you're talking about cash flows, existing cash flows, we're at comfortable ground. We have last year's 10K, we have last year's annual. We're still in our comfort zone. When you talk about discount rates, we're still often in our comfort zone because we often draw from parameters from the past, betas, risk-free rates, risk premiums. So there are dangers to doing that. It's when you get to growth that you realize that you can't put those on autopilot, that you have to make assessments for the future, and those assessments can be wrong. And that growth rate can either be a growth rate in operating income or a growth rate in equity income. If you're valuing the firm, the growth rate you're thinking about is growth in operating income. If you're valuing equity, you're looking at growth in net income or earnings per share. And everything gets tied up at the end by making the assumption that at some point in time your firm will become a stable growth rate. The growth rate is going to be less than or equal to the growth rate of the economy, which we proxy with the risk-free rate. So here are the if you were asking somebody questions to value their business, your first question you're going to ask them is, what are your cash flows from existing assets? Second question, how much risk is associated with those cash flows? You can come up with a discount rate. Third, How much are you reinvesting and how well are you reinvesting, which tells you what the growth rate is. Fourth question, when will your company be a mature company? Everything we do in valuation is tied around answering those four questions. Now, rather than do a traditional review, I'm going to do an unconventional review. About 4 years ago, I was asked, I think by, I don't even know who it was now, to come up with a presentation, the top 10 mistakes in discounted cash flow valuation. So I put the presentation together. I called it the top 10 mistakes. It didn't sound right because the minute you see that, top 10 mistakes, you get a defensive reaction, right? I don't make mistakes, so none of this is going to matter. So I've looked for different names to call this presentation, and I think I found my final iteration. I call it Dante meets DCF. You know who Dante is? He's a deeply disturbed individual. I mean, if you think about Catholic guilt carried to the nth degree, that's Dante for you. Right? Dante's Inferno. I have to confess, I did not read the book. I started the English translation after about 10 pages. I said, this is too painful. So I read the Cliff Notes version, which pretty much gets it. I mean, the basic idea behind the book is, for whatever reason, Dante decides to go to each layer of hell. Each layer is harder than the previous layer. So you have gluttony. He takes every vice, greed, gluttony, etc. different layer. So I decided to do my own version of DCF hell. So I'm going to take you through 10 layers of DCF hell. And I want you to get me out of each layer. So each layer we're going to have a test. If you fail the test, and I'm stuck in that layer. Okay? So here are the 10 layers of hell. Like my thermometer? Pretty impressive with myself. Right? So low heat to high heat. Okay? So I'm going to start off with the first layer of hell, what I call this base year fixation. You know what the base year fixation is? When you sit down to value a company, you take last year's annual report, and after a while you forget that time existed before last year. Everything gets built off last year. So I want to talk about the dangers of doing that. Then I want to talk about taxes. It's so easy to mess up with taxes and valuation. We double count them, we half count them. I want to talk about taxes. Then I want to revisit this issue of high growth, this period of high growth. How long can we let growth last? What is dangerous? Is it 10 years too long, 15 years too long? I want to come back to your discount rate. We all know the mechanics of the discount rate. I'm going to put up a discount rate computation, and I'd like you to tell me what I should be doing and what I'm doing wrong. Then I want to revisit the growth question and say, if you're going to put in a growth rate, how do I make sure you're paying enough for growth? Paying in what sense? Putting in enough money to sustain that growth. Then I'm going to revisit discount rate again, talk about this notion of debt ratios and how they affect the discount rate and whether they can change over time, and if so, how will the discount rate change it? Then I'm going to get to that elephant in the living room, the terminal value that drives so much of our DCF valuations, and talk a little bit about the constraints we put on terminal value. Once we've come up with the value, we talked about garnishing, how we add premiums, discounts, cross-holdings, control, liquidity. I want to revisit that issue of control, of discounts and premiums. And then getting from aggregate to per share value, I want to talk about what are some of the things that can trip me up getting from aggregate to per share value. And then I have a final layer of hell that I call the Wasserstein-Perella bonus layer of hell, but we'll get there when we get there. Now, every layer, you actually already have the answers. We've dealt with this somewhere in this class, but it's been so much material. Let's see if we can go back, and if you've started reviewing for the final, great. Even if you haven't started reviewing for the final, kind of throw yourself back into that session and think about what the answers are. Let's start with the first layer of hell, base year fixation. I have a valuation of ExxonMobil. I take 2008 numbers, which have just come out for ExxonMobil, and these are what the numbers look like. Revenues of $477 billion, after-tax operating income of $58 billion, net capex of $3 billion, change in working capital of $1 billion. I've been very helpful. I've even computed the free cash flow to the firm, right? Net cap, after-tax EBIT minus, so $54 billion. Cost of capital for the firm is 8%, which is actually a pretty conservative estimate. It's probably even lower than that given the size of the firm and doesn't have much debt, but let's make it 8%. And I'm going to use a growth rate of 2%. That's well within the cap, right? I've actually set it at the inflation rate. Market cap for this firm at the time that I did this valuation was $373 billion. Now, if I did a traditional discounted cash flow valuation of the operating assets, forget about the cash balance and everything else, just the operating assets, what's my value going to be? My free cash flow to the firm is $54 billion, right? That's the 1 plus G. Let's act like the 1 plus G is not even there. Right? What's in the denominator? Cost of capital minus growth rate. So 54 divided by 0.06 is how much? That's 900, 6, 8, 9, is that right? $900 billion. So what the heck are we missing? The stock is trading at 377. If we just, none of those, if you look at the numbers, I've used only three numbers, right? Free cash flow to the firm, cost of capital, and growth rate. So if you're going to disagree with the 900 billion, which of those three numbers are you going to take issue? Is it cost of capital? Is it growth? Is it free cash flow to the firm? What's the problem with the free cash flow? Technically, that is the free cash flow from 2008. So what is it that I've done wrong in my valuation that's skewing my value so far off? Ali? Don't even have to use a May. We were around last year, right? We know what oil companies did last year. You're already seeing the beginnings of this year. BP just reported first quarter earnings. They're down dramatically from last year. If I take 2008 as my base year and I build it in, I am going to build in an overvaluation into my analysis because I'm using too high a cash flow. In effect, I'm assuming that oil prices will bounce back to 120 and go up $10 every year for the rest of eternity. In which case, why am I bothering doing a valuation in the first place? Of course I'll buy ExxonMobil. But while it's obvious here and it jumps out at you, for many of you when you did your companies, it showed up in subtle ways. For some of your companies, 2008 was a terrible year. If you took 2008 as your base year, you found that your stock was worth nothing. For others, 2008 was great relative to what 2009 is going to bring in. This is something I don't think we do well enough in valuation because so much of modeling, there's too much modeling in valuation is built on, get the base year numbers, build on them, but the base year numbers don't have to be last year's numbers. Of course, how we normalize is an entire art form. So that's, you can go back and review the notes on how to normalize. But when you sit down to value a company and somebody gives you just last year's annual report, ask them for 4 more years of annual reports because you want to get a sense of how numbers move over time, not just what happened last year. Yes, please. In which case you have to use industry. That's a good point. If you have an oil company that started its operations in 2008, guess what? You have to figure out ways to normalize that company's earnings as well, even though you have only 1 year's numbers. A lot of you doing alternative energy companies. Many of these companies gained because oil prices were high last year. They're very young companies. So somehow into your valuation, you've got to bring in that expectation that when oil prices are down, the earnings are going to come down. Yeah. Only if you're doing some kind of regression, right? In a DCF valuation, there is no fixation. You still have to ask, are they building off a base? So the fact that analysts are doing screwy things with their growth rates doesn't mean you should be it's different when you're doing relative valuation, when you take the analyst base. When you're doing DCF valuation, it's your game to call. Okay? So you don't have to be stuck with whatever they used as a base year because they might have completely screwed up on what their base year is. Yes. I'm sorry? What about the volume of am I low? Let me try. I don't want the feedback to get too bad. Okay, let's try. That's really loud. Okay, I have to whisper now. Okay, ready for so you took me out of the first layer of hell. Let's go to the second layer. Let's talk about taxes. Is this too loud now? Like Goldilocks here. Let's talk about taxes. Is it too soft now? It's okay? So let's assume I come to you with a firm. Again, I'm going to keep things simple. You don't need a calculator to pull out. I saw Malik pull out his calculator. We don't need a calculator. We can actually work this without the calculator. Okay? Let's suppose I came to you with a company and I gave you these numbers. EBITDA 140, DA 40, EBIT of 100, interest expense of 20, taxable income of 80, taxes of 32, net income of 48. For 1 year's financial statements. I don't want you to do miracles. All I want you to tell me is what the free cash flow to the firm is. And then I'm going to tell you that there's no growth in perpetuity as an added variable. So with that financial statement, I need you to tell me what the free cash flow to the firm you will use in valuing the company. And I'll give you some choices. Okay? I can take the 48 million net income and add back depreciation. What's wrong with doing that? Free cash flow to the firm, right? Net income is not your starting point. You have to start with, yeah. How about 108 million, which would be, EBIT minus the taxes plus depreciation. No, I'm getting a little closer, right? At least I'm starting with EBIT, but what did I do wrong there? I did two things wrong. Let's see what the two things wrong are. When I subtract out the 32 million in actual taxes paid, I'm actually double counting the tax benefits from interest expenses because 8 million of those my taxes on the 100 million would have been 40 million with no interest expense. It's because of the interest expenses that my taxes are lower, which means if I count that 8 million in my cash flows and discount those cash flows back at the cost of capital, which already incorporates the same tax benefit, I'm going to be double counting for that. So it's got to be a starting point of 100, but instead of subtracting out 32, what should I be subtracting out? I should be subtracting almost a notional tax. That's why when we do EBIT times 1 minus T, we always revert back to a notional tax. When you did your free cash flow to the firm, if you look at what taxes you're actually building in, they'll be far higher than the actual taxes paid, but that's okay because you're going to count the tax benefit from interest expenses when you do your cost. Should I add back depreciation or not? I haven't given you any information on CapEx and working capital, right? And I'm asking you for free cash flow to the firm. But have I given you information about it? What have I given you as input that will allow you to kind of override this CapEx working capital being missing? I've told you that there's zero growth. With zero growth, how much do you need to reinvest? Zero reinvestment. If you have zero reinvestment, what's your CapEx be? Not zero. Net CapEx should be zero, which means CapEx is going to be equal to depreciation. The right answer here is going to be 60 million. Think about it because it's a critical component in how we do valuation. Two things here. One is when you do taxes, you want to make sure that you're not double counting tax benefits from interest expenses. The reason we act like you have 40 million in taxes is the other 8 million in tax savings comes from the fact that I have $20 million in interest expenses, and I'm going to count that when I do my cost of capital. The reason we have to put in a CapEx is because of zero growth. With zero growth, you have zero reinvestment. What I'm telling is when something is missing, and lots of times information is missing, your first temptation is going to be it's missing, so let me act like it's not there, which basically is what you do when you ignore CapEx. Ignoring CapEx is as strong an assumption as making an assumption about CapEx. Ignoring something is not making it go away. So ask yourself, what's a more reasonable assumption? CapEx is zero, CapEx is equal to depreciation. My guess is CapEx is equal to depreciation is a sustaining assumption because depreciation needs CapEx to keep going. And if this is forever, your CapEx better keep that depreciation going or the firm's going to run out of assets to depreciate. Little harder now. Let's talk about growth. So let's suppose I came to you with a young, high growth question. Reinvestment is zero. So in a sense, the net effect of all three of them has to be zero. So maybe the CapEx is a little below depreciation and working capital makes up the difference, but the total reinvestment collectively in this firm has to be zero, which means EBIT times 1 minus T is going to be equal to free cash flow to the firm. The only scenario where that's going to be true is if you have a growth rate of 6. Let's talk about, yeah. No, the answer is D. If you add the depreciation back in, then you're acting like there's no CapEx. Right? I mean, cash flow is EBIT times 1 minus T plus depreciation minus CapEx minus change in working capital, right? If you just stop after plus depreciation, what are you telling me about CapEx and change in working capital? That they're both zero. But if they're both zero, what will you keep depreciating? If you have six, so in a sense, you need to keep this business going and keep earnings growing in perpetuity. The CapEx has to kind of make up for that depreciation over time. I've kind of given away the answer to this question here. Let's suppose I come to you with a really promising young growth company. You've actually seen this graph way back, now when we talked about DCF valuation. You're trying to set a length for the growth period. It's just gone public. Dazzling growth over the last 2 years. And you try to decide, should I use 0, 5, 10, 15, 20? I know your tendency is going to be, let's go with 10, let's go with 15. We've done that with high growth companies. We've often given them 10 or 15 years of growth. But here's a note of caution. It is very difficult for companies to sustain high growth for long periods. In fact, this graph, which we looked at earlier when we did DC evaluation, looks at the growth rate in revenues at companies that have just gone public and compares them with the growth rate of the sector in which they are. So here's how you read it. 1 year after going public, these companies have a revenue growth rate 15% higher than the sector. 2 years after, that's down to 7%. 3 years after, that's down to 3%. By the time you look at these companies 5 years after they've gone public, they look just like the sector. We tend to exaggerate growth at high growth companies, especially when they're young high growth companies. This is kind of a note of caution saying when you get sit there and say, I'm going to use a 15-year growth period, hold back and put in 10. When you use a 10-year growth period, maybe you're better off using 5 because it's very difficult for companies in the real world to sustain growth for long periods. For 2 reasons. One is what are the 2 reasons why growth drops off so quickly? One is, the fact that they're bigger companies, right? In a sense, scale is your enemy. If you get successful, you double in size. You see this happening to Google, right? It's going to be only a matter of time before Google's revenues are single-digit growth. It's not because it's a bad company, but because revenues are growing. The other, of course, is competition. You grow, people watch you grow, they come into the business, they make your growth much more difficult to sustain. I'm not saying it's impossible. I know you can all list off the companies that have been able to grow at high rates for long periods. Microsoft, Coca-Cola, IBM. But the fact that we can list them out tells us something about what they are. They're the exceptions, not the rules, and we cannot value companies to be exceptions. Fourth layer of hell, let's visit a cost of capital computation. This is a cost of capital computation where I've done at least 6 things wrong. I want you to see, let's see if you can spot all 6. Okay? So here's what I did. Somebody came to me with a US technology firm and asked me for a cost of capital. So I proceeded to build up the cost of capital. I started with a risk-free rate of 5%. You know why? Because I thought 3% that's out there right now looks too low. Empirically, that's true. The risk-free T-bond rate right now is low, so I think it's going to bounce back to a normalized rate. That's the place with normalized rate. For the beta, I looked up the adjusted beta from Bloomberg. Adjusted rate. And for the risk premium, be ready because you're going to get to work and you're going to see a lot of adjusted betas. Don't laugh when you discuss this with a person. Act serious and say, oh, yeah, adjusted beta. Ask them just what it's adjusted for. Right? And for the risk premium, here's what I did. I looked up the Ibbotson database. It's a historical risk premium. And I took a 5% risk premium, which is the arithmetic average for stocks over T-bonds. And to that, I added a small stock premium because historically, small stocks have earned a higher return than large stocks. Put those numbers together, I have a cost of equity of 14%. Cost of capital, I took that cost of equity of 14%. I used market value of equity, but because I could not get a market value of debt, I decided to be conservative and count all liabilities other than shareholders' equity. So accounts payable, supply, credit, pension fund obligations, etc. After all, in accounting, we're taught to be conservative, right? So 50-50 weights. For the cost of debt, I used a book interest rate. And the book interest rate is I took the interest expense divided by book value of debt, came up with the cost of debt of 3%. For the tax rate, I used an effective tax rate of 30%. As I said, I made at least 6 mistakes. Let's start with the easy ones first. Let's start with the cost of debt. What are the things I did wrong? What did I use to get my tax benefit? I used an effective tax rate. What are you supposed to use? Marginally. Why? Because I said so? No, that's not a good answer. What is it about interest expenses that almost demands that you use a marginal tax rate? What are we trying to do here? We're trying to compute the tax savings from interest expenses, right? Interest expenses are at the margin. They save you taxes on the last dollar of income. That's why you can be a company with a 10% effective tax rate, but guess what? Your interest expenses find their way magically to your highest tax income and save you taxes in the highest tax income. I tell people with multinationals, if you're operating in low tax rate and high tax rate countries, and you say, which tax rate do I use? go with a higher marginal tax rate because that's where you're going to park your interest expense. There's no law that says interest expenses have to be moved around to whichever country you have the most revenues, the most income in. You can decide where to take those interest expenses, so use the marginal tax rate. So that's mistake number one. What else in the cost of debt should bother you? There's something about those numbers that are internally inconsistent right away. What's my cost of debt? 3%. What's my risk-free rate? 5%. You cannot have a cost of capital computation where your risk-free rate is higher than the cost of debt. Nobody should be able to borrow. You'd be amazed at how many cost of capital computations I see where the cost of debt is set, the pre-tax cost of debt is set below the risk-free rate using this book interest rate. With the logic like essentially being, this is what the company is actually paying on its debt. Why should I care what the cost of debt is? Because from a valuation perspective, you're going to revalue that debt at market value, and you should be using the current cost of debt, which will be built up from the default. So that's it. Weights, what mistake did I make? I used the market value of equity, is that right? Yeah. Instead of using all liabilities, what should I have used? Only the interest-bearing debt and leases if I want to. And I'm not being conservative counting all liabilities, right? Because when I count all liabilities, I push up the debt ratio, I push down the cost of capital. Don't fall into that trap of saying, let's just count everything as debt. Because if you do that, you're going to push down your cost of capital. So we've got 3 mistakes nailed down. Let's go to the cost of equity. Is it okay to normalize interest rates? There's a logic to that, right? Interest rates might bounce back. But if you normalize risk, let's carry that to the logical extreme. Why are interest rates low right now? Because we're in a recession, we have low growth, and we have high risk premiums, right? In a sense, we have a combination of things. Low risk-free rates, but those are being offset by really high risk premiums and low economic growth. If you want to change the risk-free rate and make it normalized, what else do you need to do then? You need to normalize everything. Your inflation rate, your real growth rate. Unless you want to open the door and go all the way in, you cannot selectively normalize things and leave everything else as is. That is not fair in a valuation to do that. So my argument is not that you cannot normalize risk-free rates, but if you do it, you've got to normalize everything else in your macro variables. We also know, the Bloomberg adjusted beta, we've talked about enough. I mean, clearly we know that, it's not just that it's Bloomberg. It's not Bloomberg's problem. It's one regression beta. And we all know the dangers of using one regression beta to build your entire valuation. A lot of analysts use the small firm premium. It's like a historical risk premium for small cap stocks. Let's say you run into this, 8 weeks from now, 12 weeks from now when you start at work. Do you think this is good practice to add a small firm premium to the cost of equity of small companies? I'm sorry? Well, you might be asking too much because in a sense their response to that is going to be, if you go back over the last 60 years and you look at beta adjusted returns, small firms have earned a higher return. So this is one of those these anomalies that have been discovered relative to the CAPM, that the CAPM underestimates the cost of equity for small cap stocks by roughly this amount over the last 60 years. So they're actually on pretty good academic ground in terms of this. They can point to this. But let me ask you a question. You start with a small company, you put in a small firm premium, you project the numbers out for your company. What are you doing to your small company? Over year 1, year 2, year 3, you're making your small company into a big company. So if you're going to go down the small firm premium route, the first thing I'm going to check is whether your small firm premium dissipates or disappears over time, because you should, by your own mechanics, make your firm a large firm. Here's the other problem. When we did the historical risk premium, remember we talked about the standard error in that estimate with 60 years of data? This small cap premium of 3%, and I have this in the equity risk premium paper that I referenced earlier in this class. The standard error in the small firm premium is roughly 2%. In other words, the average premium over the last 60 years is 3%, but the standard error in that estimate is 2%, which means if somebody asks me, are you certain there's a small firm premium? I'm going to have to start waving my hands and maybe there is, maybe there isn't, or maybe we just went through an extended period, especially in the 70s, where small firms did really well relative to large firms, and this premium is an illusion. Okay? So the hard line to say is no small firm premium ever. The soft line is if you're going to put a small firm premium, I'd like to see it kind of adjust to whatever the size of your firm is, year 3, year 5, year 10. So at least has to dissipate over time. You can't just leave it locked at 3% through your next 10 years and into your terminal value. There should never be a small firm premium in a terminal value computation because you have growth in your firm almost by mathematically has to become a large cap. What about the fact that it gets 20% of its revenues from Brazil? I basically ignored it entirely, right? Why? Because it's a U.S. firm. What should we be doing? We should be adjusting the cost of equity for exposure from Brazil, right? So how would I do that? What are the two numbers I need? First, I need a lambda, basically, and the 20% revenue might be a good starting point, that 20% of my revenue. What else do I need? I need a country risk premium for Brazil. So here's what I did. I went in and reworked the numbers. I stuck with the actual T-bond rate. I shifted from a regression beta to a bottom-up beta. I replaced the Ibbotson premium with an implied equity risk premium reflecting the market today. And for the cost of equity then, I also adjusted for a lambda, which in this case worked out to about 0.26. I divided the 20% in revenues that this company gets from Brazil by the average that a typical Brazilian company gets from Brazil. 0.26 times the country risk premium for Brazil in early 2009, 2.28%. My cost of equity is higher than the cost of equity for the original analysis, reflecting that additional country risk. For the cost of debt, I built up to a cost of debt using the default spread, which gives me a much higher cost of debt, 9%, because it's a very risky firm. Marginal tax rate of 40% gives me a cost of debt of 5.4%. I use market value weights. The overall cost of capital I ended up with was almost 4.5% higher for multiple reasons. Now, some things worked in my favor, some things worked against, but net I end up with a much higher cost of capital. Let's assume that you're doing a valuation, you ask management for forecasts of what's going to happen in the future. So they come back and they say, those are revenues, operating income, depreciation, capex, change in working capital, all the standard line items. Is there any way you can actually look at a set of forecasts and say, this can't stand? This won't. No. Is there any way to test a forecast for reasonableness? After all, managers say, these are the numbers, take it and run with it. What are some of the things you can look at in this forecast to make a judgment on whether managers are being reasonable or not in their estimate? Okay. In fact, let's work out how if you had, let's say you're sitting there, managers are doing the forecast. Is there a way we can quickly compute the return on capital that they're assuming? What's the growth rate they're using? 10%. What's the reinvestment rate they have each year? How would I compute the reinvestment rate? Capex minus depreciation plus change in working capital, right? Which in this case is 3 plus 3 is 6 divided by 30 is 20%. In fact, I'm keeping the reinvestment rate at 20% for the next 5 years. I have a 10% growth rate, a 20% reinvestment rate, so my implied return on capital has to be 50%. Right? So here's the question I'm not even going to ask them implied return on capital. I'm going to say, So the question I'm going to ask them is, what return on capital did you make as a company over the last 5 years? Their answer comes back and says, we made 12%. Then I'm going to have a follow-up question. So what do you think is going to change that allows you to make 50% returns on capital on your new investments in the future? When you look at forecasts and cash flows, this is the number you want to always zero in on. Because this is where people play games. They increase the growth rate, lower reinvestment, hope you won't catch them while they're doing it. But it's easy to spot, right? All you need to do is focus on the growth rate, focus on the reinvestment rate, and back into a return on capital each year and say, hey, maybe they have a really good answer. Maybe they found a monopoly in a market which is going to let them earn 50%, but let the owner shift back to them where they have to explain why they're assuming a 50% return on capital. Because any time you forecast growth and you forecast cash flows, you are, whether you like it or not, forecasting the return on capital for this company. And if you have the industry averages with you, all the better, because they say, hey, look at the industry average, it's 11%. How can you make 50% in this business? So when you think about growth, that's really the key question. Let's follow up to this cost of capital. Let's suppose I came to you with a company and I gave you the numbers and say, right now they're 90% debt, 10% equity. Here's what their cost of equity looks like. Here's what the cost of debt is. Cost of capital right now is 6.8%. Then as an analyst, I throw a number out. I say, you know what, the target debt ratio for this company is 30%. Don't even ask me where I got the target number. Let's suppose I somehow know it. What's the cost of capital for this company going to be at 30%? Can I just change, the question I'm really asking is, can I just change that to 0.7 and 0.3 and recompute the cost of capital? What do I need to do? First thing I need to do is re-estimate my cost of equity at the new debt ratio, which is going to be much higher than 7.31%. Second thing I need to do is go back and re-estimate my cost of debt at a higher debt ratio. I've tripled my debt. There's no way I'm going to be able to borrow money at the same rate. There's no easy answer to the question. In fact, it's entirely possible, and I put in 70 and 30 and I work out the numbers, that I might end up with a cost of capital higher than 6.8%, at which point you have to turn around and ask me, what sense is this a target debt ratio? Why would I want to move here if I'm going to end up with a higher cost of capital? But a lot of people, when you think about changes in debt ratio, hold the cost of equity and cost of debt fixed, and not surprisingly, always great to add debt to your firm because it makes your cost of capital. So let's suppose you do it right. Come up with a higher cost of equity, put in a new cost of debt, and your new cost of capital is 7%. You sit down to value the company. Should you use the actual debt ratio for this company or the target debt ratio for this company in doing the value? You see my question? Right now they're at 6.8%. You go to the optimum, let's make the cost of capital lower, 6.7% at the target debt ratio. So the question is, should you use the 6.8%, which is the current cost of capital, or the 6.7%, which is the cost of capital at the target debt ratio in valuing the company? You're going to save a lot of time on future valuation debates you're going to have with your, because this is, I think, a classic question in almost every investment banking and every corporate finance valuation. Is people get into this argument, should we use actual debt ratio or should we use target debt ratio? Good question. What if it's an acquisition? And follow up. If you use the target, what you then need to do is in funding the acquisition. Use 30% debt. You cannot just use the target debt ratio in an acquisition and use all equity to fund the acquisition. So if you're going to do this in your valuation, there's got to be a follow-through, and this is how you fund it. What if you're working for Fidelity or a portfolio manager? Then what do you do? No? Isn't that clear cut? So you use the current, you come up with a value for the firm, right? Could you do a second valuation and come up with the 6.7% and come up with a different value? Then what do you do with the two values? Use the lower of the two, higher of the two? This is the essence of the expected value of control. You have two values for the company. You then have to make a judgment as to the likelihood that they will move to the optimal, and what you attach as a price to the company will reflect that judgment. But it becomes a lot messier if you don't control the debt ratio, but you can't just automatically put in the target debt ratio and say, this is what the value of my company is. You buy the stock based on that price. It might never happen because it might never go to the optimal. Terminal value. Big number, right? Every one of your evaluations, I'm sure 70, 80, 90, more than 100% in some of your cases might have come from the terminal value. So I'll give you 3 ways of estimating the terminal value. I know you know the answer to this already, so I'm sure you'll give me the right answer. So the best way to compute terminal value is, in a DCF, in a discounted cash flow world, is to use a stable growth model and assume cash flows grow at a fixed rate forever. Use a multiple of EBITDA or revenues to get to the terminal value, or use the estimated liquidation. Which one do you want to rule out right off the top? You don't want to use that EBITDA multiple. If you do that, you have a relative valuation. That's a different way of thinking about value. But if you're doing a discounted cash flow valuation, at least stay true to the notion. Whether you use liquidation value or a stable growth model depend on whether you're valuing some small private business where the owner is essentially what keeps the business going, or whether you're valuing a publicly traded company. Let's assume you're valuing a publicly traded company. Let's play with some numbers. Let's assume that you have $120 million in after-tax earnings and cash flows next year, and that these earnings will be generated in perpetuity. There's no growth. Firm's cost of equity is 10%, and it's all equity funded. What's the value of this company? The no growth kind of gives you an easy way to get to the cash flow, right? Because no growth, what do we say the cash flow was? It's just the after-tax operating income. So I can take the $120 million, the cost of capital, because it's an all equity funded company, is the cost of equity. So 120 divided by 0.1 is 1.2 billion, right? So file that away. Now what if I threw in a growth rate. Let's say I look at the 1.2 billion. That's too low. I'm going to throw in a 2% growth rate. What's the value of this company now? Let's see if you fall into the trap. Mathematically, it looks like it's 120 divided by 0.1 minus 0.02, which makes it $1.5 billion. And now once you get started, well, you can't stop. Try 3%, try 4%. What am I doing wrong when I just put in a growth rate in there? Because any time you increase the growth rate, you're going to increase that. Exactly. In other words, if I leave the after-tax operating income of 120 million and throw in a growth rate, you know what I've just done, right? I've let you create growth out of nothing. If you can create growth out of nothing, you should be worth a lot as a company. The only problem is you can't do it. So you know what the missing input you need here is. What's the one number? If you wanted to do this valuation with a growth rate, what's the one number you need? What return on capital will I have? Or what's the reinvestment? Because you have to have two out of those three variables. You can't just have one, right? So you either ask me for my return on capital or my reinvestment rate, because if you have that number, you can pretty much figure out. In fact, I'll tell you something. If you set a return on capital, try this out if you want. Set the return on capital to 10%. Put in a 2% growth rate, see what you get as terminal value. You should get pretty much 1.2 billion no matter what you do if your return on capital is equal to your cost of capital. Only if you earn more than your cost of capital, that stable growth creates value. So we're getting to the hottest layers of hell here, so let's keep moving. So let's assume you're valuing a company with consolidated financial statements. This should already start giving you nightmares after that second quiz, right? That cross minority holdings, majority holdings. But we can't help it. There are a lot of consolidated companies out there. We can't make them go away. You've discounted free cash flows of the firm at the cost of capital, arrive at a value of 100 million. So you've done everything right, cash flows, cost of capital. The firm has a cash balance of 15 million. Okay, here's what I'm going to add. At each step, I want you to tell me add, subtract, or ignore. So I've come up with the present value of the cash flows. Should I be adding cash? Why? Because when I did free cash flow of the firm, I haven't counted. If I'd done free cash flow to equity, I have to be a lot more careful, right? Because then I have to look at the net income included interest income from cash. So free cash flow to the firm, cost of capital, so 100 plus 15, 150. They have debt outstanding of 20. Add, subtract. I won't ask you multiply, divide. Hopefully those choices don't even come into your mind, right? So add, subtract, or ignore. Subtract because I did free cash flow to the firm. If I'd done free cash flow to equity, I would ignore because in a sense these are already after debt. So 100 plus 15 minus 20 is 95. A 5% holding in another company, the book value of this holding is 5 million. The market value of equity in this company is 200 million. What type of holding is this? It's a minority holding, right? Add, subtract, ignore. Think about it. It's a minority holding in another company, right? Earnings from minority holdings are not part of your operating income. So when you did free cash flow to the firm, you haven't valued those minority holdings. So let me ask you again. Add, subtract, or ignore. Do you own this 5%? How much is it worth? Do you really want to ignore it? I would add it on. It belongs to you. I can see that you said minority holdings is still, and minority interest is still going to give you trouble. I'm going to send you a handout. One more final layer to make sure this gets nailed down. So 100 plus 15 minus 20 plus what? Plus 5 or 10? 10 million. Oh, final item, minority, yes. It should be the market value because in a sense we're trying to estimate the value. So if you own 5% of Google, the 5 million is a balance sheet number, but the 200 million is a market value number. If you own 5% of 200 million, it's 10 million. So in a sense, look past the balance sheet number at what the market value is. Last item, minority interest of 10 million on the balance sheet. Add, subtract, or ignore. Subtract with a caveat, right? What would you really like to know? You'd like to know the market value of those minority interests. I've given you the book value. If you could get a market value, obviously you're going to go for the market value. If you can't get a market value, you're kind of stuck with it. So here's what we have. 100 plus 15 minus 20 plus 10 minus 10. Take a look at the computation. The minority holdings get added back, minority interest gets subtracted out. Everything preferably at market value as you go along. So every step is saying, can I get a market value? Whether it's cash or, cash hopefully is already at market value, but debt and minority holdings and minority interest. You can see why it's so messy. Add, subtract, ignore. I mean, and the choices kind of get messier. I'll send you actually a little table. Hopefully that will help you out. If you're doing market value of equity, what to ignore, what to add, what to subtract, what to, so it's actually, depending on how you approach valuation, you can actually see it kind of shift in front of you. I can see you guys are going to get stuck in that layer of hell for a while. So that's why I made it a fairly hot layer, right? So, yes. Oh, there is another. Oh, yeah, actually, let's do follow-up question. This is just in case you're not hard enough. How would your answer change if you knew the firm is a target of a lawsuit? It's likely to win, but if it loses, it might have to pay out $100 million. First, will this reduce value or increase value, knowing that it's a target of a lawsuit? It's going to reduce value. So what do you need to know? Probability of losing the lawsuit. How the heck are you going to find it out? Call a trial lawyer. There are some things where you've got to accept that this is not our area of expertise. We have no idea how to assess this. But you can't ignore it, right? Because if you ignore it, saying, small chance, it might not happen. You'd have to discount it. So in a sense, it makes it incredibly difficult to value. This happened with Research in Motion for 4 years while it was in a lawsuit. It made it an incredibly slippery stock to value because this was the item that constantly kept the value kind of shifting around. But you can already see that with companies. If you think about expertise, you need the kind of expertise to kind of assess lawsuits to invest in these companies. Maybe that's something to think about. Have a lawyer as a partner, and that's his job, is to assess the probability of lawsuits being lost or won. Ninth layer, you value the equity in the firm at $200 million, estimate the value of equity per share if there are 10 million shares. No tricks here. So that's $20 per share, right? What if I told you there were 2 million employee options outstanding with a strike price of 20? That's so convenient. Because you see why it's convenient? Set equal to the value per share, right? If I use a treasury stock approach here, what am I going to get as my value per share? You don't even remember the treasury stock approach, do you? That was way, way back in time. What do I do in the treasury stock approach? I take the strike price, multiply by the number of options. So I add 40 to the numerator, and I divide 240 by 12, which gives me $20 per share. So with the treasury stock approach, it looks like these options are value neutral. But what am I missing with the treasury stock approach? I'm missing the time premium on the option, which means that these options might be at the money, but they're going to be worth more than zero. And if they're worth more than zero, I should value the options and then do what? Subtract from the 200 million and then divide by 10 or 12. 10 million shares. Let me repeat that again. If you have options outstanding and you want to deal with them cleanly, you're going to value the options as options, subtract them from your value of equity, and then divide by the actual. Don't double count, because if you divide by 12 and subtract the value of the options, you're attacking this firm twice with the same problem. So subtract the options. You've dealt with the options. Just deal with the actual number of shares outstanding. Everybody get that? So what's the right answer? 200 minus the value of the 2 million options. I don't know what those are. You have to put them in an option pricing model. Divide by 10, which will give you a value less than $20 per share. This company is going to leak some value because it has these options outstanding. Final layer of hell you've already seen. Remember this table from session 5? What did Wasserstein and Perella do wrong? This was the Kennecott merger. The two companies, they had an acquiring company and a target company, a cost of equity and a cost of capital. They estimated the cash flows to the target company, but those cash flows were after debt payments, so they're cash flows to equity. They discounted those back at the acquiring company's cost of capital. Talked about acquirers anonymous. They did two things wrong. They used the wrong company and the wrong discount rate. The way I describe it is this is about as far from the truth as you can get, and they got that. They used, in fact, the 10.5% cost of capital, which is the acquiring company's cost of capital, discount the target company's cash flows to equity, and not surprisingly, they overvalue the equity by almost 50%. I call this a final layer for because you can do everything right, estimating cash flows, you can do everything right, estimating discount rates, but if you mismatch cash flows and discount rates, catastrophic things happen in your valuation. It's not just a firm and equity, it's currencies, it's inflation. I mean, the biggest, the most common mistake in DCF valuations is people not being consistent about the way they do cash flows and discount rates and mismatching them at the end. Part of the reason it happens often is you have two teams, one working on cash flows, one working on discount rates. They get together at the very last moment, and since they haven't talked to each other, God only knows what happened in those rooms when they came up with those numbers. Right? So the risk of sounding stupid when somebody says the discount rate is such a generic term that it should almost never be used in the context of evaluation. People have to be specific. What discount rate? Is it a cost of equity? Is it a cost of capital? What currency is it in? Is it real? Is it nominal? Because the reason, if you don't match those up, then your valuation can be off by 100%, 200%, 300%. So here's what you use in your valuations. In fact, I've shown your class the fall 2007 to fall 2008. Not a huge shift. Lot of FCFF, three-stage models, general valuation models, a lot of high-growth models. There are about 8 or 9 people who kind of hang out there every year using dividend discount models, partly because they're using the value credential service because they have no choice. About 20 or 25% continue to use equity valuation models. The downside of equity valuation models is not that they're not right, but that if you decide later in the process to change your debt ratio, then it's a headache to go back and change your debt ratio. The firm valuation models, I'll give you one warning though, because you're looking at pre-debt cash flows, they're deceptive. You can look at a company, it looks healthy on a free cash flow to the firm basis, but it could be going bankrupt for all you know, because these are operating income numbers. So I actually think it's a good idea, even if you're doing a firm valuation, to work out the free cash flow to equity to see if there's that distress probability building up somewhere along that they won't be able to make the debt payments. So here's what you found. Actually, about 65% of you found your stocks to be undervalued. About 35% found them to be overvalued, which is a little more undervalued than all. Which is not a surprise, given how much A, prices have collapsed in the last year, and B, given that you're still working with 2008 base year numbers. I know you try to fight this, but there's no easy way to get around it, right? You have a mismatch of pre-crisis earnings, for the most part, and post-crisis prices, and you see that reflected in the DCF valuations. Every year I list out the most undervalued stocks, and you know the deal I made with you in the first session. I will buy one of these stocks on two conditions. One is I get to see a valuation before I do it. I know what you did. And two is you're buying too, right? So if you're on this list, if your company's on this list, and you feel really strongly about it, maybe after I've looked at your valuation, let me know, and I'll run in my, as I've said over time, about 20 stocks in my portfolio come from these classes over time. So here's a list of most undervalued stocks. Okay? Notice that there are a couple of cells on the most undervalued list, which is actually not, if you think about it, you're saying that's crazy. There's also relative valuation and option valuation, so you make a collective recommendation. So clearly I'm not buying Quicksilver or the New York Times, even though they're on the undervalued list, because you're selling. Okay? There's one hold up there, the rest are all buys. I picked these based on percentage undervaluation, not absolute differences. So here's how I did it. I divided the price by the value. The lower that number, the more undervalued the stock. Okay, so for what it's worth, that's your list of most undervalued stocks. Here were your most overvalued stocks. Actually, do you know the company that was most picked for evaluation? That Google was valued by 5 people. Okay. 4 of you found it to be put a sell, 1 had a buy. 4 were undervalued, 4 were overvalued, 1 was undervalued. Whole Foods was valued by 2 people, 1 put a buy, the other put a sell. So I mean, it happens. You can look at the same company. That's why I never stop people from picking the same company. It's not like you're going to end up with the same number just because you have the same company. These were your most overvalued stocks. You can see Ford pretty close to 0 on a DCF basis. But there's a hold on it because there was an option valuation that gives you a value of almost $15. Which actually makes sense. If you think about these companies now, you're not buying Ford for the dividends, I hope. You're buying 4 to make a bet. And if the bet pays off, it could be worth an incredible amount. So the rest were all sells other than. Now, of course, as I've said, I've added this company. I don't do it out of charity. I've actually found that the stocks you pick have done reasonably well. In fact, here's a graph that shows you the buy recommendations from this class. This is collectively versus the S&P 500 over, I picked semesters way back. Because in DCF valuation, if I picked last year or 2 years ago, you could say it's not long-term enough, going back to 96, 97, 98. Every class, every evaluation class in the 90s, if you look at the collective recommendations versus the S&P 500, have beaten the S&P 500, which is kind of a weak test because I haven't tested for, but collectively it's not as if you come up with a list of really risky companies most of the time. So collectively I feel pretty confident that if I started a mutual fund and I populated it with stocks that you pick, that I wouldn't be in pretty good shape relative to the average mutual fund. Right? But that's not saying much. The average mutual fund, after all, underperformed the S&P 500 by 1.5%. However, here are a few caveats. About 60% of all your buy recommendations make money. That's a nice way of saying 40% actually lose money. But in investing, if you can beat 50-50, you're in pretty good shape. I would not have expected that number to be 190 or 80. I was actually surprised it was as high as 60. About 45% of your sell recommendations make money. So again, suggests that there's noise in both the buy and the sell. But a note of warning. You saw the collective returns on your buy recommendations. Much of that excess return came from 1 or 2 big winners each period. And that's the nature of portfolio management. Is if you pick a big winner, that's going to pull your entire portfolio up. But I was tempted with some of those big winners to sell them early because for instance, Apple, I think the first buy recommendation came out in 99. Apple actually had another bad year left before it turned around. So these are long-term strategies, and they will not work if you give up too early. If you believe that undervalued stock portfolios earn money, you got to have the stomach to sit there with these stocks for an initial period where they lose money. Eventually they might make money, but that could take a fair amount of time. Stocks on which there was disagreement did worse than stocks on which there was agreement. For instance, I said Whole Foods buy and sell. So if you go back over time and look at stocks, there was both a buy and a sell. Much worse performance. Stocks were undervalued on both a DCF and a relative valuation basis, did better than stocks were just undervalued on the DCF basis. That's why I give you the entire list. You can sort and screen those recommendations any way you want. But look at this past to kind of give you an indication as to where you're going. Let's talk about relative valuation. Right? It's a 4-step process, right? We started off by defining the multiple. It looks obvious, as I said, even Anna Kournikova knows what the PE ratio is, but step back and say, does that? In fact, let that be your theme song. When you see somebody talk about a multiple, let Anna Kournikova's image come in your mind. It'll make you stop. Does Anna Kournikova really know what the PE is? Is it that simple? We talked about the consistency test. Numerator is an equity value, denominator is an equity value, numerator is a firm value, denominator is a firm value. Stick with that test. Don't let rules of thumb drive your judgment. 6 times EBITDA is cheap, 12 times earnings is cheap, stock that trades at less than book value is cheap, PEG ratio less than 1 is cheap. I mean, you read about these simple rules of thumb that supposedly make money. Be very careful about those rules of thumb. Those rules of thumb often have no basis in reality, and they shift over time. Right? We often use multiples because we don't want to make assumptions. The reality is embedded in every multiple are all the assumptions we make in DCF valuation, right? Growth, cash flows, risk. They're all in there. We just don't want to look at them. So the question you got to ask yourself is not whether they're there, but whether you want to take a peek at those numbers before you buy a stock or be surprised afterwards. And finally, as you noted when you did your relative valuation, there is no such thing as a comparable company. And you got that list together and you looked at each company and said, that's not like my company, that's not like my company. But you got to the 12th company in the list, you said, you know what, maybe I should make them look like my company. I need a listing. Every company is unique. We kind of pushed the envelope and we said, these are our comparable companies. That's why we have to develop ways of controlling for differences. Because no matter how hard you try, there will be difference across companies. You might not like the regression approach I use, but come up with your own way of controlling for differences. Don't let storytelling be the determinant. So if you think about all of the multiples we did, I tried to take all of them, put them on a page. Essentially, the approach we used was a very simple one. With equity multiples, we always went back to a stable growth dividend discount model, right? Price-earnings ratio, price to book, price to sales. With firm multiples, we went back to a firm valuation model. We did a little algebra. With a little algebra, you should be able to tell me, A, what the variables are. We don't do this because we want to use this equation to come up with the P/E ratio for a firm. That's pointless because we've already done that with DCF valuation. We do this so we can identify the variables that drive each multiple and come up with that companion variable, that one number you need to know to use a multiple. Remember what that number was? Let me throw a multiple at you. You tell me what the companion variable for each of these numbers should be. Price earnings, growth, price to book, return on equity, price to sales, net margin. You know that. Remember the trick, right? If it's an equity multiple, take net income and divide by the denominator. If it's a firm multiple, take after-tax operating income, divide by the denominator of your multiple. You should come up with a companion variable for every multiple. So here's what you use. A lot of EV to EBITDA, EV to sales, a lot of EV multiples to go with your firm valuations. In fact, it's entirely consistent, right? There are a fair number of price-earnings ratios hang in every time we do this because people keep saying price-earnings ratios passe. I mean, but they're pretty well-used multiple. I mean, they never go away. Few price-to-sales ratios. The problem, of course, is they are internally inconsistent, but if you're controlling for net margin, you're hoping that inconsistency gets washed out because you have the inconsistency in both sides. So that's what the distribution of your multiples look like. There were a few multiples that I couldn't quite recognize. So either you did a typo in EBITDA, debitda, some things like that. Either I think you just put in. So I made my own guess as to what you were trying to do. Okay. But maybe you've come up with this incredibly creative multiple that nobody's seen before. I'd be interested in looking at it when I get your product. Here's an interesting graph. I took your DCF values and I took your relative values. And I looked at the ratio of the two. So if the ratio is greater than 100%, your DCF value is higher than your relative value. If the ratio is less than 100%, your DCF value is less than your relative value. I'll give you a statistic. In 99, when I looked at this graph, 80% of the DCF values were less than the relative values. This year, when I looked at the graph, about 60% of the DCF values were higher than the relative values. How do you explain that? 99, what was happening in the market? That was the dot-com boom. Basically, the DCF values couldn't catch up with the market. Now you look at the DCF values, they've kind of overshot the relative value. So that might actually be a hopeful indicator for the overall market if you think about it as a measure of intrinsic value. I mean, I've actually kept track of the statistic. It's done pretty well in forecasting the future direction of the overall market. It's not a perfect predictor, but it is a statistic I kind of look at each period to see where people are relative to where the market is right now. Most undervalued relative valuation. So these are your relative valuation undervaluations. JetBlue was the most undervalued. Relative value of $20, stock price of $5. Bank of America actually showed up as, though relative to what is the good question, right? I mean, relative to other bankrupt banks, maybe, So these are your relative valuation percentage differences. I think there's a couple of cells in there, Cozy and Quicksilver. One hold, Crocs. Right? Crocs actually was undervalued DCF, undervalued relative, and still a hold? Okay, so that's what was holding you back. Yeah. Future does. Most overvalued on a relative basis. Oh, I'm sorry, something happened in Sylvia. But these were the most overvalued on oh, that's a private company, right? Okay, so that's why it's not there. But the rest are all public companies, relative values. Option pricing. We did come to option pricing toward the end of the class, and we essentially used option pricing not in the context of valuing options, warrants, convertible bonds, but to value traditional businesses. In fact, we used it in three areas. We used it to value patents, option to delay. We used it to value equity in deeply troubled companies, which is a call option. We also talked about the option to expand. Maybe sometimes it can be used to value young growth companies that have proprietary technology, something that allows them to grow. There were only 10 companies for the option pricing. So basically, a lot of the groups actually didn't even have an potential to apply option pricing in the context of their group. Because they're a money-losing company, did not have enough debt. Okay? Incidentally, if you don't have enough debt and you force through into the option pricing model, you know what you're going to find? Your equity value doesn't change very much. Because if your value comes from the liquidation option, there's not much debt, there's not much value to the option. 10 companies, 5 of these companies had close to zero discounted cash flow values before you use the option pricing model. In fact, this is the only way you could actually put a number on the company's value because every other approach gave value close to zero. Ford, for instance, DCF value close to zero, relative valuation close to zero. Only way you can justify it is with using an option pricing model. And for those companies who used an option pricing model, the increase in value you got from using the option pricing model was about 67% over the DCF value. That's the time premium and the option kicking in. So here's the big finale, your recommendations. I've actually, next semester, I probably will have to start dropping a few semesters off because I have this going from fall 98 to spring 2009. Buy, sell, and hold. This semester, there were 62 buys, 41 sells. I keep trying to make this number go to zero, but it never will. But there were 12 chickens. Okay. There were a few of you who did the thing that I said don't do, moderate buys, kind of semi-moderate buys, semi-strong buys. Either buy or sell or stay out of this game, okay? If you can't make up your mind, be a fixed income person. Don't come in here and say, I'm a moderate buyer. I feel for a semi-comfortable buyer. You either buy or sell, right? So make up your mind, go one way or the other. Right? The worst thing you can do is kind of stay in the middle and say, I can't make up my mind. But still, there were a few people who legitimately couldn't make up their minds, so I left them in the hole. Here's an interesting statistic. Look at the number. Obviously, the numbers of people in the classes vary across semesters. There was my big class. You can see spring 2007. That's the semester I came back from my sabbatical, and they loaded up 400-person classes for me. Never go on a sabbatical again. Right? What? That the spring 2007? Yeah, maybe. But you did find a lot of overvaluations in summer of 2007 when it started. So that's but that was a really disproportionately. Spring of 99 again. You can see spring of 99, fall of 99, proportionally a lot more. So there is some predictive power here. I'm not saying each of you is predicting right what's going to happen, but collectively as a group there is some predictive power in this. So lots of models out there, right? Option pricing models, discounted cash flow models, growth rate models. And what I've tried to do in this picture is take every valuation model we've talked about and kind of put it in there. Yeah? You can have asset-based valuation, liquidation value, replacement cost, discounted cash flow models, which can either be stable, two-stage, three-stage, or end-stage, equity or firm valuation models, and within firm valuation models you can have cost of capital, adjusted present value, excess return models, or equity valuation models, dividends or free cash or equity. You can use current earnings or normalized earnings, so it's all kind of choices. And if you think about all the possible combinations, you can see you can have a multitude of combinations. Relative valuation, you can either do equity multiples or firm multiples. You can do compare to the sector or compare to the market, and you can relate to earnings or book value or revenues or some sector-specific variable. Contingent claim models, you can have the option to delay, which is what we use for patents and undeveloped reserves. The option to expand, which might work for young firms or for vacant land, and the option to liquidate, which is what we use for equity in a deeply troubled firm. So everything we've kind of covered is in this graph. The question is when you sit down to value a company, you're saying, which one should I use? I have all these things in my tool chest. And the answer really depends on two things. First is what asset are you valuing? Is it a cash flow generating asset? If it's not a cash flow generating asset, you can't do a discounted cash flow valuation. I come to you with a Picasso. So what's the value? No cash flows there. It's going to be a relative value. You're going to relate it to other Picassos that have sold. It's kind of tough because no two Picassos are exactly the same. You have to adjust for I don't know what, how many noses. I love noses. So basically you have to do something in there, some way of comparison, but it's going to be relative valuation. It's going to depend on whether the asset is liquid or not. The reason being, to do relative valuation, you need market prices. If something never sells, how are you going to do a relative valuation? And how unique that asset is. If it's truly unique, again, relative valuation is not going to work. And it'll also depend upon you. So it's a combination of what you're valuing and who's doing the valuation. It'll depend on what your time horizon is. Do you see why that matters? If you have a 3-month time horizon, you're a much better candidate for relative valuation. If you have a 10-year time horizon, let me take that back. It's not your time horizon. It's your client's time horizon. You can have a really long time horizon. Your clients come back every month and say, what have you done for me lately? You're going to be stuck with relative valuation. It's going to depend on why you're doing the valuation. Are you doing it for an acquisition? Are you doing it for value enhancement? Are you doing it for active investing, passive investing? That can determine whether you use discounted or relative valuation. It'll also depend on how you think markets make mistakes. Do they make mistakes on individual stocks that are right on average, in which case you could do relative valuation? Or do you think they make mistakes, they correct over time? And they can make it across the whole market, in which case a discounted cash flow technique might work better for you. I mean, when I wrote my investment philosophies book, I said the key to being a successful investor is to know yourself. You don't care what makes Warren Buffett tick. It's got nothing to do with you. If you know what makes you tick, what you can live with, whether you're patient or whether you're impatient, you can craft an investment philosophy that's right for you. The same thing applies in valuation. Know what you're comfortable with. Know what your time horizon is. Know what you're trying to do. Find a valuation approach that fits that. What works for me might not work for you. What works for you might not work for me. So I'll leave this question. You don't have to tell me. That's a question I asked in the very first session. Now that you've tried the different techniques out, think about what you liked and disliked about each one. Think about what made you comfortable, what made you uncomfortable. Some of you, for instance, could not stand relative valuation. You let me know through your emails. This is R squared. I can't do it. This is too fuzzy. That's fine. For yourself, you've decided then that you want to go the intrinsic value. Others found the intrinsic valuation completely fuzzy. There's too many assumptions. I can't take this. Fine. Pick what works for you and kind of live on it. I'm not much for giving advice, but let me kind of wrap up this class in terms of advice. Every approach we've talked about goes back to the fundamentals. Every time we have a crisis, people say, this is the crisis that's going to change the fundamentals. I mean, the question I'm trying to answer is, does valuation matter in a market like this one? Of course it does. Valuation always matters. What the price does in the short term might be very strange, but valuation fundamentals have never changed. I mean, the same questions I have now, I heard in 99 from a different perspective. We thought, does valuation matter in a market like this one where everything keeps going up all the time? Markets change. Go back to fundamentals. Second, lots of details in valuation, right? Return on capital, growth rates, cash flows. It's easy to get lost in the details. Step back. Look at the big picture. Part of the reason I like to present my valuations as that picture is you can see the pieces. There are a lot of numbers out there, but you can see that they're all connected. When you change one, everything else will change with it. You can't just change one input, like the risk-free rate, and say, let's see what happens to everything else, because everything is interconnected. You're going to get on your desk, and there's going to be somebody who says, I've been doing valuation for 20 years. Which my response is, so what? In fact, I was on a panel with somebody who said, I've been doing acquisition valuation for 25 years. I said, that's like a mortician claiming to know the meaning of life. You get it, Basically, you've seen a lot of dead bodies around. You've probably killed them yourself, and now you're trying to tell me the meaning of life. There are a lot of people out there who've been doing the same wrong thing over and over again for 25 years. The key in valuation is to constantly step back and reassess what you're doing. It's easy to fall into bad habits, right? Every 3 years, I basically take a list of everything I do. I go down the list, and it's amazing how many bad habits I've fallen into over time, of what I use as a risk-free rate, where I go for my risk premium. It makes sense to step back and say, am I doing the right thing? Keep your perspective. It's only a valuation. It's only money. I still remember about 5 years ago, at the end of one of these classes, second-year MBA comes to me. She's graduating. She was a history major from Yale. She came back for her MBA. Usually, if you're a history major from Yale, you take the strategic MBA route. You know what the strategic MBA route is, right? You pick classes with the word strategic in their name, and you can go through 2 years without ever seeing a number. I'm not kidding. You can do it even at Stern. 2 years without ever seeing a number. But by mistake, she ended up in my valuation class, which is not a strategic valuation class. And she discovered she was really good at it. So at the end of the semester, she comes up to me and she says, I never thought this would happen, but I have a job as a sell-side equity research analyst. And I said, congratulations. And she said, I'm really scared. I said, what are you so scared about? Well, what if I make a mistake? You'd be glad you're not a brain surgeon. You make a mistake, somebody dies on the table. If you're an equity research analyst, you make a mistake, what's the worst that's going to happen? Somebody gets a little richer, somebody else gets a little poorer, right? Think like a Marxist. You move some wealth around, the world hasn't ended, move on. Right? What I'm trying to tell you is Saturday night at 11:30 you're in a heated debate, regression beta or bottom-up beta. You're pushing for the bottom-up beta, the other guy's from Harvard, he wants regression beta. Let him have his wish. It's not worth the effort. Big deal, regression beta, bottom-up beta, somebody gets a little richer, somebody gets a little poorer. Move on. Don't waste your time arguing over things when all that's at stake is a valuation. It's not even your money. That's the best thing. Okay. Final piece of advice. If you're ever given a choice between understanding everything there is to understand about valuation and being lucky, which one should you do? Don't even think about it for a second. Just go for being lucky. Something brought home to me by my mother-in-law when she came to visit in early 2000. Now, my mother-in-law became an avid investor in the 1990s, which to me should have been a sign that the market was topping off. Mother-in-law, avid investor, get out of the market now. I kind of missed that sign, right? So she comes to visit, and she would drive us crazy. She'd get up at 7 o'clock in the morning. She'd turn on CNBC. She watched it all day. She made it a spectator sport. Every time one of her stocks would go on the little ticker, go Cisco, go at the kitchen table, convinced that single-handedly she'd pushed up the market value of Cisco from $4 billion to $400 billion during the night. You couldn't argue with her. She was their big competitive advantage. All day long, all she would talk about what was in her portfolio, what was out of her portfolio, what she wished was in her portfolio, and I wasn't in the least bit interested. But I had to act like I was interested. Okay, that's very good. And then she lets it slip that she owned Qualcomm. And I was very impressed. Qualcomm was one of the great stocks at 99. It was up 600%. So I turned to her and said, Judy, how do you pick Qualcomm? I knew the minute I asked this question I shouldn't have because she told me. She said she picked Qualcomm because it owned MCI. That's not Qualcomm, that's WorldCom. And she says, Qualcomm, WorldCom, what's the difference? I said, what do you mean, what's the difference? You bought the wrong stock. You made 600%. If you'd bought the stock you really meant to buy, the stock that owned MCI, you'd have lost money. She wasn't the least bit phased. I was afraid to ask her after that why she owned Cisco. Afraid the answer might be, I really like that vegetable oil. Or Saturday Night Live, which is disco. I mean, who knows what drives that particular. But after she left, I did try a strategy out. Pick a company in the news, pick one that rhymes with it. You know what? If I started making money, who cares about fundamentals and cash flows and valuation? My next book would have been the rhyming stock strategy. But unfortunately, it didn't work for me. So my parting wish for you is the very best of luck, and I will see you at the final either tomorrow or next Monday. Tomorrow's final is going to be in 265 from 1:30 to 3:30. Monday's final is going to be in this room from 11:15 to 1:15. And make note of that. I'm sorry, no, that can't be right. I'll get back to you on the time. That can't be right because that's a corporate finance final. No, never mind. I'll get back to you on that. The next Monday is your final, whatever time it's at. Okay. So I will see you. Thank you.